So now let's revise that cut. Let's start with question 1. Now, question 1 was impairment, but now for public sector under IPSAS, and we see that how do you determine the value in use as well as the impairment for public sector? And we see that there are 3 methods you can use. One was the depreciated replacement cost approach. The other one was cost restoration approach. The other one was the service unit approach. And we say that, how determine that? So that you take the cost of the asset, don't copy country, you raise depreciation so that you get the carrying amount. Once you get the carrying amount, then you take the replacement cost, then you raise. Then from there, it will depend on the method you're using. So in this case, we're using the service unit approach. So once you raise depreciation, you get the depreciated replacement cost. Once you get the depreciated replacement cost, then we are able to get the recoverable amount. And that's how you get the impairment loss. I have read the question. And after that, 5 years ago, the county government of Kanairo constructed a public picnic facility to promote domestic tourism at a highly subsidized fee. 5 years ago. The original cost of the facility was 750. So the cost was 750 million. Was 750 million and was expected to provide service to 1 million tourists each year over the estimated 25-year useful life. Was to provide service, was to provide 1 million tourists each year over estimated 25-year useful life. But you see, it was constructed 5 years ago. So therefore, when determining the depreciation, so take the cost of 750, you divide by the estimated economic life of 25, so that you get the depreciation per annum, but you're told that 5 years ago. So how much will be the accumulated depreciation? 150. So that means at the date of impairment test or analysis, how much was the carrying amount? It was 600. Second paragraph, then you're told that. Due to economic hardship suffered by the Kenyans as a result of the bottom-up government policies, the number of tourists visiting the picnic facility drastically reduced. The revised estimate of the number of local tourists expected to continue with the visit approximated 14 million tourists over the remaining 20 years. Only 14 million. But what was our estimate? Our estimate was 1 million each year for 25 years. The current replacement cost of the new facility is 900 million. So the replacement cost is 900 million. You raise depreciation 900. You assume the same economic life of 25 years. You assume the same assessment after the same period of 5 years. 180. So that means how much is the depreciated replacement cost? 720. And do that. The current replacement cost of the new facility is 900 million. The facility is depreciated using straight-line method required. Calculate the impairment loss on the picnic facility, if any, using the service unit approach. Service unit approach. Now, for the service unit approach, now the depreciated cost, this should be our recoverable amount. But in this case, now the proportion of the number of tourists, domestic tourists who will visit, has reduced. So you take the proportion, that is 720. Now, the estimated, let's go back to the second paragraph. Due to economic hardship suffered by Kenyans as a result of the bottom-up government policies, the number of tourists visiting the picnic facility drastically reduced. They reduced. The revised estimate of the number of local tourists expected to continue with the visit approximated 14 million tourists over the remaining 20 years, we only expect 14 million over 20 million. Can you go back to the first paragraph? The first paragraph, the last sentence. First paragraph, the last sentence. That the original cost of the facility was 750 million and was expected to provide service to 1 million tourists each year. 1 million, 1 million, 1 million. So remember, this facility was constructed 5 years ago. So the remaining 20 years, 1 million for the next 20 years. So the expected number of tourists will be 20. But now it has changed to 14. So you take 14 million over 20 million. You take the proportion. You get 504. And that becomes your recoverable amount. Therefore, the impairment loss is A minus B. When the carrying amount exceeds the recoverable amount, you get an amount of 96. Good. You can take a screenshot. And now let's go to the second question. That's good, yeah. Question number 2. Briefly explain 3 types of share-based transaction, clearly indicating the accounting treatment. Types of share-based transactions. And we say that there are 3 types of share-based payment transaction. Number 1 was the equity settled. Number 1 was the equity settled. Equity settled share transaction. Number 2 was, the cash settled share transaction. And number 3, we had hybrid or combined equity and cash transaction. Those are the 3 types of share transaction. Wherever you say that under equity settled share transaction, this where an entity will carry out a transaction and then settles the amount payable through the issue of its equity instrument. Now the question is, what was the accounting treatment? In case of equity settled share transaction, you say that you debit expenses, you credit equity. Cash settled share transaction is that this is where an entity carries out a transaction and then settles the amount payable in cash, which will be measured with the reference to the share price of the entity. The amount will be settled in cash, but that amount will be measured using the share price of the company. And what are the journal entries? Debit, credit. That you debit what? Expenses. Then you credit liability, correct. Then for the hybrid, this is where the amount settled or the amount payable is settled by both cash and equity. So what will be the journal entries? Whether you pay cash, whether you pay equity, it's an expense to the company. So you'll be debiting the expenses, then you credit either equity or liability, depending with the amount they have paid. Good. So you already have them that in your notes. Part B of the question. B of the question. Part B of the question. This is question 2B. You're told that Kasongo Limited granted each of its 400 employees 10,000 share option in the company on the condition that they remained in the employment for the next 4 years. So that's what we call the vesting condition, and the vesting period is 4 years. Each option was valued at 20 shillings as at the grant date. So that was the grant date price. Then I told that Kasongo Limited predict that 5% of the employee will leave the company in each. So therefore use the reducing balance. Yeah, 5% of the employee will leave the company in each of the next 4 years to seek for better offers being offered by the competitors, Mulima Limited, and thus lose their option rights. Required. Show how Kasongo Limited should reflect the the arrangement for each of the 4 years in the financial statement. Now, how do we account for this? So here we have the periods. Here, then we have the equity, and then we have the expenses. The vesting period was 4 years. So year 1, year 2, year 3, year 4. How many employees do we have? 400. First of all, you had just the number of employees. 400. Then you multiply by, we estimated that 5% of the employee will live in each. So use the reducing balance. So year 1, you multiply by 95%. Year 2, yeah, you can use 90%. The other one, 85. The other one, 80%, which is the same as, year 1, you can take 400 times 95%. Year 2, you can also take 400 times 95% times 95%. You get the same outcome. In case it's varied, it only varies by 1. That year, you can still take 400 times 95% times 95% times 95%. Or alternatively, year 1, you can take 400 times 95. What do you get? 40, 20, is it 380? Year 2, now you take 380 times 95%. You get 360? Well, it will only vary maybe by 1, because in this case, it will be getting 360. Yeah, then the other one, you take 361 times 95%. Actually, you have all those options. So now let's use the easier one, the first one. So once you get the number of employees, then you multiply. Each employee was granted how many share options? 10,000 share options. And then you convert it into monetary terms by multiplying by the grant date price. This is an equity settled share transaction. The shares will be measured and recognized based on the grant date price. And the grant date price was an amount of? And then we amortize for the 4 years. 1 of the 4 years, 2 of the 4 years, 3 of the 4 years, 4 of the 4 years. 19? Sorry? 19 million, eh? 19 million. The second one is 30? That's 6 million. And that is 6 million. 41 million. Lastly, you get an amount of? Get 64. So therefore, for the expenses, year 1 will be 19 million. From 19 to 36, that's an increase by how much? 17, eh? From 36 to 41, you get? This was 51. This was 51. So that's an increase by how much? 15. From 51 to get an amount of? I think good. Now the question was, show how Kasongo Limited should account for it. So how do you account for it? So what do you debit? What do you credit? And so you see that you debit expenses, you credit equity. Year 1, year 2, year 3, year 4. Let our shillings be in thousands. So for the expenses will be 19 million, 36 million, 51 million. Sorry, those are not expenses. This will be 17 million, 15 million, 13 million. Then for the equity, we have 19 million, 36 million, 51, and an amount of 64. Good. You can take a screenshot. Now let's go to question number 3. Question number 3, there was a small challenge there. Yeah, that's on income taxes. Yeah, most of you told me that they have a challenge with income taxes. Kindly don't worry. Income taxes is one of the easiest. God willing, during our Brock's revision, I'll do as many questions as possible. The first question, the second question, by the time we'll be going to the third question, even I will not have to do it. Mtaniambia sasa wacha hapo. Ni kama sasa tumeanza kushikanisha. So don't worry about the income taxes. Question number 3. Now, for the income taxes, on the determination of deferred tax, I did go through those theories. What's deferred tax? Deferred tax is the amount of tax payable in the future, which arises as a result of temporary differences. What are temporary differences? Temporary differences are the difference between the carrying amount and the tax base of an item. What is carrying amount? Carrying amount is the amount of an item shown in the financial statement. What is the tax base? Tax base is the amount allowable for tax purposes in the Simple. So here we'll be having the items. We are saying that deferred tax arises as a result of temporary difference. A temporary difference is the difference between the carrying amount and the tax base. And the difference between the two, that's how we get the temporary differences. Of which you say that there are two types of temporary differences. There is a taxable temporary difference and a deductible temporary difference. Taxable temporary differences, there are temporary differences which gives rise to deferred tax liability. Deductible temporary differences are temporary differences that gives rise to deferred tax asset. Question 3. Kwisha Mimi Group is estimating the deferred tax liability as at 31st of May 2022 and has provided the following information. Number 1, property, plant, and equipment, that is PPE. So we need now to determine the temporary difference, which is the difference between the carrying amount and the tax base. So that the carrying amount is the amount that will be shown in the financial statement by an accountant after doing the necessary adjustment. So this is you. So this is the accountant. Then the tax base is the amount that will be allowed for tax purposes in the future. So therefore, this is the tax man. The difference in perception between an accountant and the taxman is what gives rise to deferred tax. So number 1, we have property, plant, and equipment has a cost and revalued amount of 100 million. Cost and revalued. So that means they have already revalued the asset. And accumulated depreciation of how much? 18. Total capital allowance on PPE amounted to 30 million. The temporary difference due to the revaluation of PPE amounted to 2 million, and the tax rate is 30%. Now, this is you. How to determine the carrying amount? Is the cost minus depreciation. So the cost of the asset was how much? 100. Then you raise accumulated depreciation of how much? 18. And that's how you get the carrying amount, which will get an amount of 82. Now let's go to the taxman. The taxman does not recognize depreciation. He recognizes what? The capital allowance or wear and tear. So therefore, you'll take the cost minus wear and tear. Can you give me the cost minus wear and tear? You get an amount of 70, or which should not be 70. Let's read the question again. Property, plant, and equipment has a cost and revalued amount of how much? 100. That's the cost and revalued amount. The taxman does not recognize revaluation. He will only allow for wear and tear from the original cost. Now, this 100, we are told that is the cost and revalued amount. So you take 100. Let's go to the last sentence. The temporary difference due to revaluation of PPE amounted to how much? 2 million. So that means of this 100, the revaluation gain was 2 million. Therefore, the question is, how much was the original cost? Yeah, the original cost was 98. Now, this original cost, this is where now the taxman will provide for wear and tear. And the wear and tear was an amount of that. And that you get an amount of 68. Good. So therefore, you take 82 minus 68. And how much will be the temporary differences? Sorry? 14. But of this 14, 2 million, remember, has already been included here, arose as a result of revaluation of PPE. Remember, you said that revaluation changes for PPE and available for sale will have a special deferred tax treatment. Number 2, the group has available for sale. So we also have available for sale. The group has available for sale financial assets that were purchased during the year at a cost of 10. So we purchased them during the year at 10. There was a revaluation gain of 2 million reported in available for sale reserve. So there is available for sale. You purchased at how much? At 10. Then during the year, there was a gain by 2. Now you as an accountant, how much do you show as the financials in the financial statement as the value of available for sale? You as an accountant, how much do you show as the value of that asset? 12, correct. You'll show 12. But you think to the taxman does not recognize revaluation. The amount that will be allowable for tax purposes is the amount you paid to acquire that investment, which was an amount of 10. So that now we have a temporary difference of 2, which was as a result of revaluation. Good. Number 3. The group spent 50 million shillings to develop a new product. Yeah, so it's a development cost. So therefore, you have an intangible asset. Intangible asset. It's provided by IAS that you capitalize those costs. The group spent 50 million to develop a new product, out of which 10 million has been charged to the income statement as amortization for the year. Any accountant. The cost to incurred was an amount of how much? 50, but you have charged amortization. It's more of depreciation. An amount of how much? 10. So that means the carrying amount in the financial statement is how much? 40. What about the tax base? 0. At least you crammed that one. That for intangible asset, the tax base is always equal to 0. So it will be 40 minus 0. You get an amount of 40. Let's read that again. The group spent 50 million to develop a new product, out of which 10 million has been charged to the income statement as an amortization for the year. The balance of 40 million is shown as an intangible asset in the statement of financial position. Yeah, the amount shown in the financial statement of financial position is what we call the carrying amount. The full amount of 50 million was allowed for tax purposes in the future. The full amount of 50 was allowed for tax purposes in the year. Remember, tax base is the amount allowable for tax purposes in the future. But this amount of 50 was fully allowed during the year. So how much will you allow in the future? 0. Good. Because the full amount was already allowed during the year. Number 4. Total inventory. So we have inventory. Inventory is an asset. Total inventory was carried at 20. Was carried. So that's the carrying amount. Was carried at 20. Which was the net realizable value. That means cost minus cost to sell. That was the row off. Total inventory was carried at 20 million, which was the net realizable value. The cost of inventory was how much? 22. So when you go now to the taxman does not take the revaluation, which is the net realizable value. He will only allow the actual amount paid to acquire that stock. And how much was the cost of the stock? 22. Then you are told that there was unrealized profit of 1 million that has also been deducted from the inventory on consolidation. Remember, this is Kwisha Mimi Group, so it's a group of companies. As an accountant, during consolidation, we eliminate the unrealized profit. So that means of this 22, we had already deducted and eliminated the unrealized profit. So you add back an amount of 1 to determine the original cost of that, which was an amount of 23. Hope you understood. The carrying amount we are given, of which the cost of the asset was 22, of which during consolidation, we had eliminated provision for unrealized profit of 1 million. So on consolidation, remember, for tax purposes, the taxman does not recognize the group aspect. The taxman does not recognize the group aspect. There is nothing to do with group of companies. So in this case, the taxman only assesses each company individually. So you cannot give them consolidated financial statement. They have to separate the two. So take the cost of 22, which was after deduction of unrealized profit of 1. So that means the original cost was 23. 20 minus 23, you get 3, which is a deductible temporary differences. The other point, trade receivables. Trade receivable amounted to that million. So that's the carrying amount, amounted to that million. After making a provision of 2 million for bad debt, remember bad debt, it's a desirable expense until they become specific. The amount also include a foreign exchange gain of 1 million. The exchange gain or losses and doubtful debts are only allowable for tax purposes when realized. So that means the exchange gain was unrealized. For tax purposes, unrealized income are not taxable. So now we adjust here. Trade receivable, as an accountant, you have shown it an amount of that, which was after making a provision for doubtful debts. So provision for doubtful debts usually add to the debtors or reduce? Reduce. So that means you have already reduced. So how do you adjust? you adjust by adding it back, because provision for doubtful debts is a desirable expense until it become specific. So we add back a provision of how much? 2. Then we are told that there was also an unrealized profit of 1 million, unrealized profit. Now, an income is something you expect to receive, right? So do you include as debtors or you exclude? An income you expect to receive. So include, it's a receivable. So in this case, there was unrealized gain. So that means since it's an income, they had already included. But I told that income is not realized. So unrealized income are not taxable. So you adjust by eliminating. So in short, what I have done, I've taken that, you add back the expense, you eliminate the income. So therefore, the tax base will be an amount of 31. So you get 1, which is deductible. And then the other point, trade payables. Trade payable were carried at 40. Carried, that's the carrying amount. Trade payables were carried at 40 million, which include, okay, include. So how do you adjust? I don't overthink. If they include, how do you adjust? You deduct. When they include, you don't add. When they include, that means they have already included. So you adjust by eliminating. So you just take 40, which include 5. You eliminate that 5 to determine how much was the actual trade payable, which was an amount of that 5. And now let's read the question. But this question, you can know how to avoid them. If they include, you eliminate. If they have eliminated, you just need to add it back. Trade payables was carried at 40 million, which include an accrual of 5 million, which relate to pension and other employee benefits to be paid in year 2023. That's the coming financial year. They are these are only allowed for tax purposes when paid. They are only tax allowable on cash basis when paid. So since they have already been included, you eliminate them so that you get the actual amount of payable. So how much is the temporary differences? 5, which is negative. Is it negative or positive? It's negative. What do I say about liabilities? And what do I say about liability? Trade payable is a liability, right? For liabilities, you recognize the amount negative. So you'll be taking negative 40 minus negative 35, and you get negative 5. The liability, you show them as negatives. Lastly, the deferred tax liability as at that 1st of June 2021 was 8.5. Now, can you give me the total temporary differences? Sorry? 47. Which is positive. If it's positive, that's what we call a net taxable temporary difference. A taxable temporary difference will give rise to deferred tax liability. So, deferred tax liability. So just take the tax rate of 30% times 47. 4.7 times you get? That's 14.4. 14.1, eh? 1. What was the question? Compute the deferred tax balance as at 31st of May 2022 and the charge to the income statement for the year. So how do we get that? So we already have the deferred tax as at the end. So what do we charge to the income statement? Remember, we said that an increase in deferred tax liability is an expense. A reduction in deferred tax liability becomes an income. How do you determine the increase or reduction? You prepare the deferred tax account. How do you prepare the deferred tax account? Deferred tax is a liability, so therefore the opening balance will be on the credit side, and then we have the closing balance on the credit side. The balance carried down is 14.1. The last note we had already been given. The deferred tax liability as at 1st of June 2021 was an amount of 8.5. Then you see that you factor in the revaluation changes for PP and available for sale. If it's a gain increases the tax expense. A reduction reduces. So an increase is where we have the balance brought down. A reduction is where you have the balance carried down. So therefore, you'll be factored in the revaluation gains But in case it's a loss, it reduces the tax liability. So here we'll be having a revaluation loss. But you only consider for two items, PPE and available for sale. So we had a PPE. How much was the revaluation? Correct. It was 2, not 14. So PPE, so take 30% of 2, which is 0.6. We also had available for sale. Available for sale, there was a revaluation gain of 2, which is a gain. So available for sale, 30% of 2, you still get 0.6. 14.1, this side is more than this, 14.1. So how much do you take to the P&L? 4.4, which will be, is it an income or expense? This is an expense? Yeah, it's an expense. You see, when you credit the deferred tax account, that means you debit P&L. We debit expenses. This is what it means. It was an increase. We had 8.5 plus 0.6 plus 0.6. But at the end, the balance was how much? 14.1. So it's an increase. So an increase in deferred tax becomes an expense. Can take a screenshot. Question number 4. And question number 4 was IFRS 16. Heard that? A company entered into a 4-year lease commencing on 1st of January 2018 and intends to use the asset for 4 years. The terms are 4 payments of 50,000 shillings commencing on 1st of January 2018. So that's at the beginning. So that means we are paying in advance and annually thereafter. The interest rate implicit in the lease is 7.5%. And the present value of the lease payments not paid as at 1st of January 2018, that is 3 payments of 50,000, discounted at that rate is 130,026 shillings. Legal costs to set up the lease incurred by the company were 402 shillings. Required. Show the lease liability from 1st of January 2018 to that 1st of December 2021 and explain the treatment of the right of use asset. Read that question again. Read it again. So now let's account for that. Now the question is, are we paying in arrears or in advance? We are paying in advance because we is commencing on 1st of January 2018, of which the first payment was paid at that date. So how do we account for this? Number one, we need to have a lease liability. And we say that a lease liability is initially measured at present value of lease payments not paid at the commencement. We lease this asset for how many years? 4 years with an annual lease payment of how much? 50. So therefore, get the present value, you'll be taking 50,000 times present value interest factor of an annuity. Interest rate is 7.5% for 3 years. So it will be 50,000 times 1 minus 1 plus R, 0.075 raised power negative n. That's negative 3 over 0.075. What do you get? You get 130? 3? 0.20? Yeah, and that's what you are given. You may wonder, why am I using 3 years? Or 3 years or 4 years? It's 3 years. You see, we leased for 4 years. So here you have to pay 50, 50, 50, 50. But in this case, we are paying in advance. So that means before the asset was available to you by the owner of the asset, you first paid the first deposit of 50. So it's already at its present value. So that one is no longer liability. So therefore, the liability at the commencement, once you get the asset, will be what you have not yet paid. When you are paying in arrears, that's when you discount for the 4 periods. But in this case, the first period, you won't discount it because it's already at its present value. Actually, it's no longer a liability. Why? Because before you got the asset, you had already paid the first installment of 50. So therefore, the liability is what you have not yet settled, the remaining 3 payments. Then we also need to get the right of use asset. And how do you get the right of use asset? See that it comprises of 3 elements. One is the lease liability. Then we add the payments in advance. Yeah, the 50, the first 50. That one we have not included here because it was already at its present value. And then you add any initial direct cost. The lease liability we have is 130, 0.26. Then the payment in advance. So you had already paid an amount of 15. And then there was legal cost that was incurred, an amount of 4. And that's how you get the right of use asset. Get 180, 428. That's the initial recognition of the right of use asset. Then subsequently, how do you recognize the subsequently? You recognize using the cost model. That is the cost minus depreciation. And you say that how do you depreciate the asset? Based on the ROA of the lease period and the asset economic life, of which in this case they are the same for 4 years. So 180, 428, the lease period was for 4 years. Get 45? 106, 107. Oops. So subsequently, we'll be taking the cost minus depreciation. What about liability? This liability is on initial recognition. What about subsequently? Subsequently, we amortize. So you come up with a lease amortization. So here we have the period. And that was for 4 years. So from 2018, 2019, 2020, 2021. I'm sure you crammed the format. We start with the opening balance. Balance brought down, then payments, correct. This one we are paying in advance. So payment, and that's how we get the balance due. Now, this balance due is what now will attract the interest. So interest at the rate of 7.5%, and that's how we get our balance at the end, balance carried down. Balance brought down, remember we are amortizing the liability. We are amortizing the liability. So the liability we had was 130,026. Then the payment, we are paying in advance. How much is the payment? 0. The first period is 0 because this 130, we had already paid this 50. So it's no longer a liability. So the first payment, the first period, we are not making any other payment. So therefore, the balance will be 130,026. This what now will accrue an interest at the rate of 7.5. Sorry? 2750? 9752. The balance carried down, you will be taking the balance you had at the beginning, you add the accrued interest. You add the two. So you'll be having 139,778. The balance carried down becomes the opening balance, 139,778. Then you pay in advance. How much are you paying? You pay 50, and the balance will be 89,778. This balance you have is what will attract the interest for the year. So 7.5% of that. 67? That 3, eh? So take the balance at the beginning, you add the accrued interest to get your total liability at the end. 96? 511. The balance carried down becomes the opening balance, 96,511. We pay in advance an amount of 50. So therefore, our balance will be an amount of 46,550. 511, eh? 511. This balance is what to attract the interest for the period. Sorry? You take the balance brought down, you add the interest to get the balance carried down. Yeah, you get approximately 50. The balance carried down becomes the opening balance. We have 50. Then we are paying in advance an amount of 50, and your balance will be 0. So now, how do you prepare the financial statement? Okay. Financial statement extract. Okay. So to the income statement, you recognize two items. So we have the expenses. Number one, there is the interest expense, as well as we have depreciation on right of use asset. Now, these are the interest expense for each year. We have 97.52. Here we have 67, 33, 34.88. Final year, no interest. And then depreciation per annum was 45,107. Now, what about the statement of financial position? So here we recognize an asset as well as a liability. So under the non-current assets, and we have the right of use asset. The right of use asset was an amount of 180,428, but this was at initial recognition. So you deduct the depreciation for the year minus 45,107. How much will be the net book value or the carrying amount? 135? 305? 321. 135, 321, you minus depreciation for the second year, you get 9214, right? 214. You minus this, you get 45,107. You get 0. Then what about the non-current liabilities? whereas we have a current liabilities. So the non-current liabilities, we have a lease obligation. They say that when you are paying in advance, to the non-current liability, you take the amount of balance due. If you are paying in arrears, you take the balance carried down. Also to the current liability, we have a lease obligation. When you are paying in arrears, we say that you take the principal. But when you are paying in advance, the payments goes. Take the payment. And remember, I say that a liability is what you expect to pay or not to pay within the next one financial year, That means for 2018, the liability will be for 2019, within the next one financial year. So for 2018, you take for 2019. So to the non-current liability, you take the balance due. This is the balance due, which is an amount of 89,778. For 2019, you take for 2020, which will be an amount of 46,511 dash. Payments. We have a payment of 3 payments. We only have 3 payments. So for 2018, you take for 2019. So of which 2019, we expect to pay an amount of 50. For 2019, you take for 2020, we expect to pay an amount of 50. For 2020, you take for 2021 an amount of 50. Simple. Can take a screenshot. Last question. Have a question. Question number 5. Question 5, you're told that Evibes Limited issued 500 convertible loan. Now, this is a financial instrument. So that a financial instrument is a contract that gives rise to an asset to one party and a liability to another party. So the first thing you do is to identify whether this transaction is it a financial asset or financial liability. Evibes Limited issued 500 convertible. So we issued. So Evibes issued. Therefore, is it a financial asset or financial liability? Asset or liability? This is a liability. Now, this is how you argue, because this is where most of students go wrong. When we issue, now take a scenario. The government issued bonds. When did the government issue bond? When they are borrowing money, right? Then for you, you buy the bonds. Are you together? So when you purchase the bond, to you becomes a what? It's an investment, right? But to the government, they are borrowing. So the issuer is the borrower. Another scenario. When the company issues shares, the company are issuing shares, right? So that means they need money. And then you purchase those shares. So you'll say that I have invested in this company, right? So that means that you purchased. If you purchased, that one becomes an asset. The issuer becomes a liability. That's why we find equity and liability. Equity means that this is the money the company they're using, but does not belong to them. It belongs to the owners of the company. So therefore, in this case, if Evibes issued, therefore it's a financial liability. Evibes Limited issued 500 convertible loan. And then this is a convertible loan, is a convertible security. And you see that a convertible security is known as what? A compound instrument. Compound instrument. That is, it will be having both the debt and the equity element because it's convertible. So that means you have an option of converting it into ordinary share. So that means it has an equity element. But what we showed was our own note, which is a liability. So it's a compound instrument. That means you separate the equity from the debt. And how do you get the debt? For the debt, you account for it using the amortized cost. Mnaniangalia kama tu kusoma hii. Tulisoma hii? I don't remember that. Yeah, actually I've put for one of the classes, one of the revision classes, financial instrument. It will not be a pure revision. It's a repetition of what I did in class. If possible, you can just at the back of your book, you can decide either to write the notes afresh or you just reason. You wait for the computation part. So, but in this case, when you will be reasoning, reason to understand. Write to understand, not to finish. Because financial instrument, you will never miss a question on financial instrument. AVEBS Limited issued 500 convertible loan note on 1st of January 2021 at par. Each loan note is redeemable in 3 years' time at its par value of 2,000 per note. Yeah, most of the debt, they always mature at their par value. So therefore, the maturity value always mature at its par. Remember, they issued 500 loan note, each with a par value of 2,000. So that means, how much were they borrowing? 1 million. They just needed 1 million for 3 years. So that means after 3 years, they returned the 1 million in full. These are loan notes. It's not a normal loan. A normal loan we pay in reducing balance, but this one we only pay upon maturity, of which upon maturity you have an option. If you had invested in this company, you have an option of converting it into equity. Instead of receiving your cash back, you get shares of the company. I will read again. AVEBS Limited issued 500 convertible loan note on 1st of January 2021 at par. Each loan note is redeemable in 3 years' time at par value of 2,000 per note. Moses, angalia swali. Alternatively, each bond can be converted at the maturity date, that is 1st of January 2024, into 125 10 shillings ordinary shares. The loan note pays interest annually in arrears at a coupon rate based on the nominal value of 6%. So you have the coupon interest. The interest is 6% based on the nominal value. Now, this is what we call the nominal value. If you take the number of securities times par value, the whole amount is what we call the nominal value, which is 1 million. That means the annual interest will be an amount of, and that's an annuity, 60, 60, 60 for 3 periods. The prevailing market interest rate for the 3-year loan note without conversion rate is 9%. That's the effective rate. And you see that, what's an effective rate? It's the same as the market rate. It's the same as the market rate. Required. Prepare an extract of the financial statement for AVEBS Limited for each of the year ended that 1st of December 2021, 2022, and 2023. Get your 20 marks. Kibarua kianze. This is a compound financial instrument. So therefore, it cannot be classified as amortized. It cannot be classified as amortized cost. In case of a compound instrument, since we have a conversion, they can be converted into ordinary share. You separate the equity and the debt instrument. Let me write it here again. That a compound instrument is an instrument with both debt element and the equity element. And the requirement is that you need to separate the two. How do you separate? What you just need to determine is the debt element. And debt element will be measured now at amortized cost. That is the present value of future cash flow. This is equivalent to the present value of the future cash flows, which will be the same as the value of an annuity. Now, in this case, the annuity is the interest. plus at the end, you get back your amount, which will always mature at its par value. So you add the present value of maturity value. So therefore it will be, annuity is the, you'll be receiving, you'll be paying the interest of 60, 60, 60. So it's an annuity. So you'll be taking 60,000 times present value interest factor of an annuity. We discount the cash flow using the prevailing market rate. And the prevailing market rate is 9% for 3 years plus present value of maturity value. Its maturity is at its par value. So which is 1 million. Present value interest factor. This is not an annuity, it's a terminal benefit. So 9% at the end of year 3. So this million, or 60,000, sorry, 1 minus 1 plus R raised power negative N over R plus 1 million. This is not an annuity, so it's 1 plus R raised power negative N. 1 plus 0.09 raised power negative 3. Computer, give me the determinant. You're getting an amount of 924, 061. Now that's the determinant. What about the equity element? We say that to get the equity element, you take the full amount, the debt value. The debt value, they raised to 1 million. You eliminate the equity. Sorry, it's not the debt value, but the fair value or the full amount, which was 1 million. Of this full amount, we eliminate the debt element. Now the debt element, it's 924,061. Now the balance will be the equity element, which is an amount of 70, 75, and 39. Equity does not change. But for the liability, you amortize for the lease period or for the period of 3 years. So you prepare amortization schedule. And we are amortizing the liability, that's the debt. We have the period, when was it issued? So you have to prepare for 3 years, 2021, 2022, and 2023. So you have balance brought down. Then we have the interest expense. This is the liability at the prevailing market rate, 9%. Then there is the coupon interest. Coupon interest does not change, it's an annuity, and that's how you get our balance carried down. The balance brought down, we are amortizing this debt element, amount of 924,061. Interest using the current market value, they are supposed to pay an interest of how much? 9% of the opening balance, sorry? 83? 165. But there is what they had agreed, they'll be paying each year. So which is an amount of 60. So 60 year 1, 60 year 2, 60 year 3. So this one you deduct. So you take the balance brought down, you add the accrued interest for the year, you deduct what they have already paid. So how much will be the liability value at the end? 947, 226. The balance carried down becomes the opening balance, 947,226. Interest using the current market rate, 85 to 50. You take the opening balance, you add the interest accrued for the year, you deduct what they have already paid. 972, 476. The balance carried down becomes the opening balance, 972, 476. Interest at 9%. 86. 87. 520. 523. Take the opening balance plus the interest for the year. You deduct what they have already paid. You get figure close to 1, of which this 1 million was the maturity value. This was the maturity value. So what was the question? Prepare an extract of the financial statement. I prepare the financial statement extract of income statement. This was a financial liability, which will give rise to expenses. And what is the expense? The interest expense. Good. Interest expense. And you take the interest expense using the effective date, not the coupon date. So an amount of 83,165, 85,250. Then we have 87,523. What about the statement of financial position? So here we have, it was a financial liability, so therefore under equity and liabilities. To the equity, we have an equity reserve. Equity reserve. This was the equity reserve, an amount of 75 each year, 75,939, 75,939, 75,939. So what will happen upon maturity, that is as at 1st of January 2024, if you convert into ordinary shares, that's when now they recognize ordinary share capital. Meanwhile, it's a reserve. So if they don't convert, that means they just take the money, you de-recognize. What do you mean by to de-recognize? Yeah, you remove it from financial statement. And then we have a liability and a non-current liability. The non-current liability, we have a loan note, a 6% loan note. Here you factor in the balance carried down. Is an amount of 947,226, 972,476. Then here we have 1 million. So you can take a screenshot. So I think that cut was very fair. So you also do cut too. So you take it seriously, just take it seriously. I have also strike a balance. Based on the topics. So up to what we have covered. So actually, once you receive that cut, even if I will not be around to monitor you, it's to help you, not to help me. So take it. If you know you are busy, leave it. But make sure when you get time yourself. Just give it 2 hours. 2 hours. Don't do it for more than 2 hours. Because another thing, you might be having content. In exam, we usually say that no matter how sharp you are, you also need to work on your speed. You need to work on your speed because Every exam will be timed 3 hours. Can you imagine doing 2 questions? 2 good questions and the balances. But now 3 hours is over. Even if you get 20 marks, 40 marks cannot make you pass, no matter how sharp you are. So you also have to also work with speed. Yeah, speed is very important. Yeah. Sio kusoma swali mara 10. Ukisoma mara ya kwanza uone kabisa it's not making any sense, go for the second reading. You go for the second reading, you are still not understanding, just move to the other question. Are you together? Yes, and then don't do it to balance. Show them that you know there is something you can, at least you can be able. For example, in this case, try to show that you know how to get the maturity value, the coupon interest. This is what will give you some marks. And once you're okay here, just write what you can be able to manage. But I think that's enough.